Today, we're looking at how executive pay can be closely linked to performance to benefit organizations in the long run. This approach means that senior leaders, from CEOs to other top executives, are rewarded based on their real contributions to the company's success and not just short-term gains or market changes. More and more companies are adopting these performance-based pay models because they lead to stronger governance, meet investor expectations, and align leadership decisions with shareholder interests and ethical standards. Without this alignment, companies risk rewarding poor performance or encouraging risky behaviors that can hurt long-term competitiveness. By tying executive compensation to clear goals like customer satisfaction, innovation, growth, and sustainability, executives are motivated to prioritize what really matters. This also builds trust with shareholders who want transparency and accountability, knowing leaders earn their rewards through measurable results. Overall, this approach helps improve leadership accountability and enhances the company's reputation while supporting its strategic priorities. Performance metrics give us an objective way to evaluate how well executives are doing, which helps improve governance and ensures that pay is tied to real value creation. Rewarding meaningful contributions not only attracts top talent but also helps keep high-performing leaders who focus on delivering results. Well-designed long-term incentives encourage executives to think beyond quick wins and focus on sustainability, innovation, and resilience. To align executive compensation with performance, it's important to take a systematic approach. First, define clear strategic goals that are measurable, relevant to long-term success, and within executives' control. These might include revenue growth, profitability, operational efficiency, customer satisfaction, ESG performance, or market expansion. Then, select a balanced set of performance metrics, since no single measure can capture executive performance fully. Financial metrics often used include revenue or EBITDA growth, return on capital employed, earnings per share, and total shareholder return. This balanced approach supports effective compensation strategies that reflect overall executive performance. When designing executive compensation, it's important to balance multiple types of performance metrics to avoid any negative effects, like compromising quality just to boost profits. These metrics typically fall into three categories: operational metrics such as cost reduction, efficiency, and productivity, customer and market metrics like Net Promoter Score, customer retention, and market share, and strategic or ESG metrics covering areas like sustainability goals, innovation milestones, safety, compliance, and diversity. This balance ensures executives focus on long-term value creation rather than short-term gains alone. The pay structure itself usually includes a base salary that accounts for about 20 to 40% of the total package, providing stable fixed compensation. Short-term incentives come as annual bonuses linked to yearly goals, for example, profit targets, sales achievements, or customer outcomes. Long-term incentives, on the other hand, are equity-based rewards over a 3 to 5 year period, designed to align leadership with the company's strategic progress and shareholder interests. Common forms of these long-term incentives include performance share units and stock options, which encourage sustainable growth and accountability. Restricted stock units or RSUs, along with benefits like pension contributions, health benefits, and allowances, form an important part of executive compensation. A balanced combination like this encourages leaders to focus on delivering steady, long-term results instead of just chasing short-term bonuses. To support this effectively, strong governance is essential. This means having independent committees oversee remuneration, clear disclosures in annual reports, regular performance reviews, consulting shareholders on significant changes, and keeping compensation plans simple. Good governance creates fairness, transparency, and accountability. Compensation should also align with market standards, considering things like industry, company size, location, and role complexity. Benchmarking is a useful tool to attract the right talent without overpaying. Finally, applying clawback and malus provisions helps protect the company by recovering incentive payments if misconduct, accounting errors, excessive risk, or ethical violations occur, reinforcing accountability and safeguarding shareholders. Apple ties a significant part of its CEO's pay to stock units that depend on how well the company performs compared to the S&P 500, which ensures rewards align with long-term value for investors. Unilever includes sustainability goals like reducing carbon emissions and responsible sourcing in its incentive plans, showing a clear commitment to both its stakeholders and its strategic mission. Tesla uses a unique CEO compensation plan based on reaching ambitious market value and operational goals, which has generated great value for shareholders but also raised questions around fairness and risk. Johnson & Johnson evaluates its executives using a broad scorecard that looks at financial results, quality, innovation, and environmental, social, and governance metrics, helping reduce dependence on any single performance measure. The main benefits of performance-aligned compensation are that it strongly motivates executives by linking their rewards directly to success, aligns leadership goals with shareholder value by encouraging long-term thinking, improves overall organizational performance by supporting strategic objectives, and promotes transparency and fairness in how executives are rewarded. Stakeholders benefit from clear visibility of how pay outcomes align with performance metrics, which supports transparency and accountability. Long-term incentives encourage executives to focus on sustainability by driving innovation, resilience, and strategic investments that benefit the company over time. However, there are some challenges to keep in mind. If too many metrics or complex conditions are used, it can confuse stakeholders and reduce motivation. There is also a risk that executives might focus too narrowly on meeting targets, potentially sacrificing the organization's long-term health. Poorly chosen metrics may cause misalignment, leading to unintended behaviors or skewed priorities. Market volatility can also distort compensation outcomes, impacting fairness during economic shocks. Lastly, benchmarking practices that aim for pay above the market median can create upward pressure on executive compensation overall. Balancing these factors is essential to designing effective and fair remuneration structures. Executive remuneration tied closely to performance is a key part of good corporate governance. It makes sure leaders are rewarded fairly based on the actual value they add. When compensation plans are well designed, they help improve how the organization performs, align efforts with strategic goals, and build trust both with shareholders and employees. There are challenges, like figuring out the right metrics to measure performance and dealing with economic uncertainties, but the benefits far exceed these difficulties. Using a balanced mix of financial and non-financial measures, including long-term incentives, and maintaining clear and transparent governance, creates a system that encourages sustainable growth, ethical leadership, and long-term value for everyone involved.